Thanks for watching. Today, I am going to cover the biggest mistakes new investors make in multifamily real estate investing. The good news is these are a mix of personal mistakes and mistakes other investors have made. You get the benefit of learning from these mistakes without the expense. If you follow some of these lessons and avoid the mistakes, you can have faster and greater success than those before you. Please watch the whole video, as I didn't put these mistakes in rank order. Each property is different. Mistake number 10 on this list could be the worst mistake ever to your property. Before we get started, please hit the like and subscribe buttons below. Mistake number 1. Skimping on cash reserves. Failing to hold enough cash in reserve when you purchase a property is a great way to ensure you find yourself struggling when unexpected maintenance expenses occur. When it comes to future property expenses, there are two things you need to account for upfront: capital expenditures and maintenance reserves. CapEx refers to the major systems and appliances that effectively increase the value of the property. Maintenance reserve refers to those recurring expenses which keep the property functioning and operating. To fund maintenance reserves, you'll need to set aside a fixed amount per unit per year. I cover how I model for this expense in other videos, at the time of purchase, and how to fund your ongoing reserve monthly. This relegates maintenance expenses to its own line item in your budget. Funding for capital expenditures on an ongoing basis is accounted for by holding funds in reserve. This is difficult to do when you first buy a property, unless you raise the money with your down payment or equity when funding the deal. In some of my deals, I have also looked for a concession from the seller at closing to fund these obvious issues, or those found during inspection. In either case, the best way is to anticipate and plan for maintenance costs and capital expenditures. As I covered in How to Buy Your First Multifamily Property, this is done by thoroughly inspecting the property prior to the purchase, then price out anticipated repairs and replacements, and reevaluate your numbers to make sure the deal still makes sense. Many new investors make the mistake of not enough cash reserves prior to purchasing their first property. So they are always playing catch-up, trying to fund reserves at the same time, while depleting them with normal routine expenses. Don't make this mistake. Mistake 2. Betting on future cash flow. Closely related to the previous mistake, investors get themselves in trouble by purchasing a property with negative cash flow, while they don't have sufficient operating capital or cash reserves, or a small cash flow per door, which doesn't allow them flexibility in the business as a new operator. They do this with the expectation that they'll be able to get the property back into profit shortly after closing. I've seen a lot of deals like this in the last 2 years, the seller using pro forma data in the sales pitch, and new investors jumping on it. Rents go up, and they also go down. Don't forget they go down during short periods of time as well. You may be able to get away with this risk short term, or it won't happen in your ownership window. But don't set yourself up for a failure. More likely, you'll get into the property and find increasing occupancy and/or rates to be a much heavier job than you anticipated. Vacancy will be higher than you modeled due to all the turnover. Then, you're stuck with an underperformer that'll drag you down, or the rest of your portfolio. Tell the seller, if raising the rents is so easy, how come you haven't done it? Instead, go for cash flow on day one. Make your offers on current rents, and let the sellers make necessary changes if they want to share in the upside. If you can't make the numbers work in your favor on the day of closing, then it's time to either renegotiate or walk away from the deal. Don't make this mistake. Mistake number 3. Hoping for appreciation. No one knows what the future holds. If you did, you wouldn't be in this business. You would have bought Amazon at IPO or Tesla, or another more lucrative bet. Living on a beach somewhere. There once was a day with the standard method of investing, was buy low, sell high. Not like today, which many people bank on the greater fool theory, where they acquire a property at market value, then turn it around a few years later for a quick and easy buck. I'll repeat it again, you can't predict the future. No one can. In a rising market, you may be able to get by with this approach for a little while. But, when the market turns, which at some point it most certainly will, you'll find yourself in serious trouble. With negative equity, and poor cash flows. Answer this: what sophisticated investor will buy it then? And at what discount? If your sole reason for purchasing an investment property is a hunch that it'll appreciate enough for the numbers to make sense, then you're planning to fail. Instead, focus on cash flow. If the property can't bring you sustainable income, then don't buy it. Don't make this mistake. Mistake number 4. Building the wrong team. Real estate is a people business. Your success greatly depends on who you surround yourself with. I recommend building yourself a team of competent, reliable professionals to work with on a regular basis. When you fail to identify the best people to work with, you'll often find yourself stuck with misinformed real estate brokers, or sketchy mortgage lenders, and unscrupulous property managers. When transitioning from single-family to multifamily homes, many real estate investors also find it harder to manage these properties. From finding tenants, leasing, collecting rents, and handling evictions, these require a certain level of skill and experience, in addition to legal knowledge. If you don't think you're able to handle this on your own, seek out a professional property management company. But keep in mind, hiring the wrong, or a bad property manager is a big mistake. See our video on the top questions to ask a property manager. This will help you during your interview process. From my experience and that of other investors I know, these people can harm your business in a number of ways, from sheer incompetence to willful fraud and embezzlement. Take your time here. Run your due diligence on the people you work with, as well as the properties you buy. Lean on fellow investors, mentors, and experienced partners in your market to help identify the very best people for your team. Don't make this mistake. Mistake 5. Ignoring the housing market and demographics. This is possibly the biggest mistake a real estate investor can make when investing in a multifamily rental property. And it's a mistake they make before 99% of the process starts. Most of the time, beginner investors are tempted to buy and invest in their local housing market, simply because they feel comfortable about their investment being close to them. This does not guarantee success. Many investors have great success with long-distance real estate investments. I for one own a handful of properties over 2 hours away. As you should know, investing in the right location is key, especially when investing in multifamily real estate. These are examples of some questions to ask prior to investing. Is your local housing market a buyer's market, or seller's market? What is the cap rate of rental properties? What about job growth, population growth, unemployment, and tenant laws? Are all these factors favorable for a multifamily rental property investment? The answers to these questions might be no, meaning it's best to invest in another market. You can easily avoid making this mistake by performing a real estate market analysis. It'll provide you with all the information and data you need to make the best investment decision, and find out whether or not investing in multifamily real estate in that area is even profitable. Talk with other investors in the market to gain additional insight. Take the extra steps to avoid missing the bigger picture. Don't make this mistake. Mistake 6. Rushing into a deal. Building a real estate investment portfolio takes time and effort, both before you acquire the property and afterwards. So don't rush the process. Properly executing your due diligence takes discipline and time. If you are going to make sure a property is truly up to your criteria, you have to be willing to go through the process of dotting every I and crossing every T. No matter how promising the deal looks on paper, take your time. If you cannot see it firsthand, make your offer with the subjectivity of a buyer walkthrough. This will give you time to see it in person, so you know what you are buying. Definitely, take the time to see the property in person, and run through every step on your due diligence checklist. As an example, I had a recent deal I thought looked good on paper. It looked opportunistic and I had the ability to make some improvements, and turn the property around. I made an offer with the subjectivity of seeing it in person. When I saw the building in person, simply put, I didn't need an inspector. There were too many undisclosed issues in plain sight. I told them I pulled the offer and we walked away. Sometimes things looked good on paper for a reason, but then not as good in real life. Don't make the mistake of being in a hurry. Wealth creation from real estate is a long game, and powerful if done right, and painful if done poorly. But rushing the process won't help. New investors sometimes cut corners, skip due diligence, and make mistakes that end up costing them tens of thousands. In contrast, veteran investors learn to operate with fast speed. Fast, not foolish. Again, don't make this mistake. Mistake 7. Buying the wrong property. Some new investors get into the real estate business with a clear desire and dreams for success, but an unclear vision for how to get there. They want to buy properties, but they have no idea which ones. So, they bet on the first good deal that strikes their eye, but end up with a property they can't handle. Another example of when investors often make mistakes is when they wander outside their target market to buy a property they otherwise had no business looking at. This usually happens when a broker or another investor emails over a quote-unquote great deal. When these kinds of opportunities spring up, fear of missing out, or greed, will kick in and propel you down the wrong path. Before you know it, you'll be outside your area of expertise, and trying to breathe life into a flailing property in a market you don't understand. Or involved in a type of deal you don't understand, financing structure, or too much leverage as a result of reaching for a deal. These will also put you in over your head. To avoid this mistake, you need to develop well-defined investment criteria. Stick to your goals, and let everything else pass by. To succeed in this business, you need to know what you're looking for before you start searching. Otherwise, you'll have no way of knowing a good deal from a bad one. Don't get caught chasing the wrong deal for you. Don't make this mistake. I hope you liked this video. These are some of the common mistakes new investors make in real estate investing, but there are obviously others. If you found this video helpful, please like and subscribe to the channel. Or share it with someone who will find it helpful. Thanks for watching.